Hello, this is Jordan, and this video is being recorded on Wednesday evening, January 3rd, 2018, and I want to wish everyone a Happy New Year, a healthy and profitable 2018. And in this video, I'm going to discuss a potential change in the correlation between gold and bonds, and specifically long-term bond prices. Now first, before I get to the correlation chart, I want to discuss, with respect to bond yields and the various bond yields, what is bullish for gold and what is not bullish for gold. Now, a steepening yield curve is bullish for gold, while a flattening yield curve, which we've had recently, that's bearish. So in the context of an inflationary environment or an environment of rising bond yields, we want to see the longer-term bond yields rising faster than the short-term yields. And if we look at what's been happening, let's go back and just say since the end of the summer, since September, the 2-year yield has been screaming higher. I mean, that's at a multi-year high now. It's almost at 2%. That's been leading the charge. Now, the 5-year yield that recently broke out, that's trading at now around something like a 7-year high. So that's a very significant breakout that we've had in recent weeks. But the 10-year yield, kind of a good proxy for long-term yields, as we can see, that has not broken out yet. It closed today at 2.44%. That has not broken above 2.6%. If it broke above 2.6%, that would be a very significant breakout. So essentially, in the environment that we're in, what would be bullish for gold, or really bullish, would be we see the 10-year yield break out and start rising much more quickly than the 2-year yield. The opposite of that has been happening, where short-term yields have been rising faster than long-term yields. But if we zoom in on the 10-year yield in the last month or so, I mean, it's holding above the 200-day moving average, which is flat. The moving average is probably going to start to curl up a little bit. So the 10-year yield has been able to hold above that. I think it is going to continue to rise and at some point break above 2.60%. But now let's get into the correlation, because that's really the main focus of this video. And let's talk about what's happening right now. And what we see is gold has been able to break above 1300. It's even closed above the resistance at 1310. So it's been able to trade above the 1300, 1310 resistance area. And it's not that far from challenging for a major breakout. And a major breakout would be a move above the 2016 highs around 1360 or 1370. Of course, I think in tick terms, the recent high in September of 2017 was 1360. So gold is not that far from having a chance at a really significant breakout here. And meanwhile, let's look at the 10-year bond price. In the previous chart, we were showing the bond yields, and in this one we show the 10-year bond price, and then at the bottom we show two correlations. They're both rolling correlations, and so the first one is just a rolling 50-day correlation, and the second one is a rolling 200-day correlation. And we can see that until the last few months, the correlations were extremely positive between gold and the price of the 10-year bond. So in other words, the gold price has been moving in the same direction as the price of the 10-year bond. That would mean opposite yields. And so a recent concern has been, well, if we see much higher yields, that's negative for gold. But of course, that's not factoring in the potential for inflation to rise much faster. And again, what we've seen recently is we've seen stronger shorter-term yields. The Fed's starting to hike a little bit more, but nevertheless, they are not hiking fast enough to really reduce inflation or reduce inflation expectations. And with respect to the 10-year bond price, we can see that it's really at a risk here this year, at least in the first half or so. I mean, it's trading at support, so perhaps it bounces and rallies for several months. But there's really a risk here of a major breakdown below that blue support line, and that would take the 10-year bond price down to its lowest levels since the middle of 2011 or so. So we're talking about a 6 or 7 year low potentially. And I've been thinking, well, ultimately, we get a big breakdown in long-term bond yields. Ultimately, that's bullish for gold, but maybe at the beginning, it won't be bullish for gold just because of the psychology of higher nominal rates, and maybe inflation hasn't really taken off yet. But if we look at the correlation study there in the last couple months, the positive correlation between gold and bonds has broken. I mean, it's broken down, and we can see that the rolling 50-day correlation has now gone slightly negative, and that hasn't happened for more than a year and a half. And if we look at the rolling 200-day correlation, that's also that looks like it's at the lowest level in almost 2 years. So it's a very interesting thing to keep an eye on, and specifically that is how gold will potentially act if we see a spike in yields in the long-term bond prices, specifically the 10-year bond price here has a major breakdown. I think in the big picture, and eventually it's going to be very bullish for gold. I have some skepticism that it's going to be immediately bullish for gold, but we'll have to see here. I mean, we'll just have to wait and watch, and potentially, perhaps I'm wrong, and perhaps the breakdown in the 10-year bond price, perhaps that would coincide with a major breakout in gold. So in any event, what's happened in the last couple months, the change in correlation here, it's something we have to continue to watch, but at least for here and now, it is a bullish development for gold and precious metals, and we'll see if that sustains itself in the weeks and months to come if bond yields spike and if the 10-year bond has a big breakdown here. Now, you can follow all of my work at thedailygold.com. You can consider signing up for my premium newsletter. It's only $149 for 6 months. You can go to thedailygold.com/premium. My focus is on market timing and stock selection in the juniors. If you want to know which juniors have the goods and best potential, you can sign up for our service. It's highly affordable. I have many sources in the industry that help me decipher which are the real juniors that really have a chance of making something happen, or have a chance of discovering or defining a quality deposit. Those are the ones that I focus on. Not the juniors that are just out there promoting and kind of mining the market itself. So you can follow all my work at thedailygold.com. You can consider subscribing at thedailygold.com/premium. And I want to thank you for listening and watching this video, and I look forward to publishing another video update for you in the weeks ahead. Thanks.